I'm Osborne Foreman, and in this week's portfolio update, I'm going to address a video that was made a few months ago about how investing portfolios are full of lies. But I'm going to address this by giving my entire stock market performance since inception, or April 7th, 2020, and also my biggest mistakes and also the biggest winners. And if you like the video or find it enjoyable, please drop one of these, not that, one of these, support the channel. And make sure to watch until the end of the video, as there is a lot of information in this one and I think it's quite valuable. Before we jump in, I'm not going to name the original content creator, as firstly the video was removed and I don't want to spread any hate or any negative energy towards that creator. However, if they do see this video, I hope that they respect my points, and if they do want to dive deeper into it, then they are more than welcome to. They had raised some incredibly valid points that does encourage users that are watching people on YouTube to do some due diligence, so I also hope that you would do the same with my content. I'm very confident that the original video was not made with me in mind, and instead this was focusing on some more bigger fish in the lake, as I am very much a very small fish in this large lake. But some of the points made in that video could certainly relate to my content, and such I want to make my point. According to Google Finance, in the last 4 days, the FTSE 100 is up 2.71%, the FTSE 250 is up 2.31%, and the S&P 500 is up 1.69%. My portfolio has underperformed the markets for this given week, and I've only gained 1.63%, but that's likely as one of my holdings has dragged the portfolio down somewhat. However, once more from last week, my total portfolio value has actually increased, and that's not because I've had some superior performance, rather I've just been adding more money, and this was prior to the end of the ISA allowance, in which I squeezed every bit of cash that I had possible inside my ISA shelter. So as you can see now, I have a blank slate. There is £20,000 available to invest, and I now have a cash position of 3.5%. My thoughts behind holding this cash position is now that I've built up some fairly substantial holdings, and therefore I feel that perhaps now is a good time to build up a cash position and then take advantage of some discounts that previously I may not have been able to have taken advantage of. You could obviously build a cash position when first creating a portfolio, but I felt that it was more important to get a majority of my net worth invested in the market so that I may not miss out on the swings. Now, since this cash position could still be quite substantial, but not as substantial to the overall size of my portfolio, I feel it's a good time to build one, especially as the markets are going up and perhaps there is less value in the markets. I'm going to aim to have roughly 10% of my portfolio as available cash, but I love to buy stocks, and so this is very unlikely and probably will not last more than a month. Although I largely suspect that this tax year 2021 to 22 is going to be my slowest year in investing yet. This is because I'm going to be earning less money than ever. My YouTube income has not even been 1/3 of what it was a few months ago. One could argue RPM, or revenue per 1,000 views, is down. That is true. I'm also uploading less videos, and my views have declined by well over 50% in the last month. I also do not have savings like I did have last year. Last year I had some cash savings that meant in June 2020 I was able to deposit £4,000. This time I have no savings. I'm not transferring an ISA that I had last year or the year before last. Now I'm starting fresh, and this is dependent on how much of my income I can save, which I'm confident I can save a majority of my income, but my income may be less. Chances are I could be made redundant in the next half of the year. Whilst sure, hospitality is reopening and I do work in a bar or pub, well, same thing really, this could mean that perhaps sales don't go as well. Perhaps, let's say, the reopening of our economy doesn't go to plan. Perhaps the furlough scheme isn't extended, at which point there is a chance, a slim chance, that I could be made redundant, and therefore I want to assume that I'm going to be earning a lot less than usual. This could even mean that I have less shifts, therefore I'm making less money. It's also very, very unlikely, that window's very distracting, it's also very unlikely that I'll make a bag like I did with Argo blockchain. I managed to invest my trading 2-on-2 referral income, invest it, and managed to double my money due to investing in Argo blockchain. I'm going to assume this is very unlikely, and therefore it's not going to happen that I'm going to be able to deposit as much money as possible just before the end of the ISA allowances. I think that was quite a very lucky event, to say the least. All of these factors combined means that it's unlikely that I'll be able to, despite saving a huge majority of my income, get anywhere close to the ISA allowance. I feel that this will be my slowest year in investing, and as such I'm going to expect the worst but hope for the best, and perhaps maybe, just maybe, I might be able to earn more from my job, maybe more from YouTube, or even Patreon. Link in the description down below. I like to start with my stock market mistakes, as I believe we learn more from our mistakes than from our victories in that regard. My worst performing investment in the entire portfolio was the likes of SMWH, or WH Smiths. This was a stock I had loads of conviction with. I believed in how they could dominate the future, as they were located primarily in travel hotspots like service stations, train stations, or even in hospitals. So I thought that as travel started to happen again, especially a lot of domestic travel, as we would be seeing people likely unable to fly abroad, but likely travel in the UK as we have high vaccination rates, I figured that this would be a great play. And in truth, I'm not entirely sure why I sold this position, and at a loss. I took a crystallized loss of 6.48% overall. But that's not the bad thing, that's not really a big loss. It's instead what I could have had if I had held on to that position. And I could have been up from my share price, and I sold at roughly £10 per share. My average price was probably around a similar amount. I could have been up maybe 80% on that investment, which would be my top riser in the entire portfolio. However, at the time, I largely suspect that I sold this position to invest in Boohoo, at which point I feel that that's a perfectly valid decision to make. But if this wasn't the case, then this likely was one of my biggest mistakes, or the biggest mistake that I'd made in the portfolio. I only held this stock for 2 months. If I'd have even looked at it as a swing trade, perhaps it would have been more advantageous, but I sold as I did. I don't think I feared the fact that it was dropping, and in fact, if I had managed to continue buying the dip, I likely could have had much better performance than I do today. I believe that this was one of my most critical mistakes, as it was a company whose visions I truly aligned with in the long term, yet I still decided to sell. I think to take from this, I'm going to write down my reasons for selling before selling an investment, so I may get to check a second view on the matter before deciding to sell. Perhaps then I may not have sold this position, but as I said, if I did invest into Boohoo, at the moment it may look like a mistake, but if Boohoo does better over the longer term, which it is a higher conviction holding, then perhaps this will look less of a mistake years to come. A controversial choice on the channel that I invested in Royal Dutch Shell. In fact, it was so controversial that my thoughts on Shell and BP were actually one of my most popular videos of all time, and managed to get more dislikes than likes, which is quite impressive. I bought this company with the expectations that they would be able to continue paying their dividend, as they had done so since World War II. I had bought on the first day of investing in my portfolio, on the 7th of April 2020, at a share price of £14.99 each. Obviously, since then and over the next few months, I'd managed to average down as the share price continued to fall. But I realised that I really didn't understand the business, and that the cutting the dividend was only more fuel to the fire. I decided to sell and take a crystallised loss of only 4.51%. So in that regard, if these are my top 2 fallers, I'm fortunate to not have had a big loss, or not crystallise a big loss. And despite taking this loss, shares would still be down on my investment. I'm not sure by how much, but it's fair to assume that it could be a very similar amount, as shares are currently trading at around £13.35 as of this video. At the time, if I had seen this investment as a swing trade, I likely could have capitalised it on better. I might have been more likely to have taken profits when they were available, but instead I had deluded myself into thinking that I could hold this stock for the long term, and that I was going to hold every single stock that I bought for many, many years. This is not the case. Our strategies change. Mine in particular has changed dramatically over the last year, as I focus more on growth stocks instead of dividend stocks. Although when they were dropping, I did invest that capital into Boohoo, and for that point I only lost 4.5%, and that was a good store of cash in which I was able to buy Boohoo in their dip when they had dropped to around £2.40 per share. So likely the opportunity cost was minimised with this investment, and hopefully it's more of a benefit in the longer term future. However, there is another stock that I made an absolutely catastrophically poor decision on, at least on paper, and this would be Softcat. Softcat is a stock I sold for a crystallized loss, or profit even, of 2.33%. However, if I'd have just kept holding, even for 1 month longer, I could have made so much more. I decided that I was just going to liquidate my position and invest it in higher conviction stocks. I still agree with that opinion, as I believe Softcat is unable to build a substantial moat. A prime example of this is that they have low barriers to entry in their industry. And an exact example is the fact that Softcat was able to start their business, or was founded, in a shed. If someone in a shed can start a business as to the size of it is today after 20-30 years, then what's stopping their competitors from doing a similar thing? Obviously, changes in the market environment happen all the time, but I feel that I had less conviction on this statement alone. I decided to sell as they were more focused on dividends, and as I said, I've moved to a more growth focused portfolio, and my selling could have been a large mistake. I sold this stock, whereas if I'd have continued holding, I could have been up nearly 70% on this investment over just a few months, and I sold in mid-December. Everything is easy in hindsight, as everything in hindsight is 2020. But in reality, if maybe I had seen this as a swing trade, I would have been more likely to have held on. Perhaps then would have been more inclined to take profits on the way out and not sell for a loss. I think a good life hack or a mind hack when investing would be, imagine if we had a fee of £100 for selling an investment before 1 year has elapsed. Perhaps then we would be more unlikely to sell these stocks and more likely to sit at least for a year to see how they've performed. I don't think this would be a good example in most cases. I've certainly dodged a lot of bullets, but in terms of making profits, it certainly could be a great way to think about your investments. I did transfer this money into a stock that I have much higher conviction in. In fact, my highest conviction stock of all time currently in the portfolio is Games Workshop. I invested a majority, if not all of that proceeds, into Games Workshop when they were trading at around £90 per share. Sure, at the moment they've not performed that well. However, I feel that over the longer term that Games Workshop will outperform the likes of Softcat, and therefore over that time period it will benefit my portfolio more to have my money in Games Workshop. There were so many different stocks that I bought over the last year as I was still trying to figure out how to invest. Fast forward 1 year, I still don't know how to invest, but I do hope that I've gained some experience that may help me in the future when investing in the stock market. Whilst I could talk about every single one of my mistakes, like buying UK gilts or government bonds, I feel like the most important ones to mention are Redrow, a house builder that I had bought at the start of my portfolio for around £4.50 per share, now trading 47.7% higher, but I did sell this stock as my convictions on the housing market had changed. Perhaps this may not happen, but I believe that once stamp duty freeze had ended, that the housing market would stagnate. There would be less buyers than sellers, prices would drop. This wouldn't be a good thing for house builders, but I definitely agreed with Redrow's management's decision of moving out of London and into the countryside as people look for more space and to work from home. I still sold it out of this, and I invested about half and half into Boohoo and Games Workshop, which are two stocks I have much higher conviction with. And so whilst yes, it could likely be a mistake, I feel that I had to trust my gut on this one. But you can choose for yourself whether you believe that this is a mistake on my behalf, or maybe you believe that Games Workshop and Boohoo may do better in the future. Ashtead Group was a fantastic and also fortunate stock that I managed to acquire in my portfolio, and they've gained over 77.35%, and it's done really well. And in truth, I was lucky to stumble upon this stock as I looked at stocks on dividenddata.com, looking at their dividend history and dividend growth rate over the last 10 years. I found that this was a fantastic stock compared to others in the FTSE 350, and therefore I went and bought it. Argo Blockchain had also done very well for me, and I'd gained over a bag or over 100% on the investment, although this was outside of my Freetrade ISA and in my Trading 212 general investment account, so the performance isn't counted in that regard. Although I am also still invested in Argo blockchain, so it could still very much backfire upon me. In total, my entire portfolio since the inception of the portfolio on April 7th, 2020 is very complicated. According to Simply Wall Street, my total return is only 13.1%. However, this assumes that the stocks I sold, like Redrow, WH Smith's, that this money I just kept as cash and never reinvested ever again. This is not the case. I reinvest everything that I sell, other than the cash position that I have now. Instead, they base their calculation off of a much larger figure, which would be £33,000, which I definitely do not have. According to Stockopedia, I'm up over 20,000%, which honestly is a bit disappointing as it's a premium service. I am using the trial, so I will not deceive you in that regard. But I was expecting a perhaps better performance tracking, especially as I imported my entire portfolio, including my deposits, and I thought that they would calculate a weighted return. When looking at the likes of Freetrade, they do have their own performance tracking. However, since April 7th, 2020, the performance is inaccurate at best. It says that I underperformed the FTSE All-World ETF by over 17%. But that's because they started tracking performance well before I had invested or even had any money in my portfolio. Whereas if we look in the last year, which does cut off the first 2 days, I'm outperforming that same fund by over 7%. That's 7%. My most accurate figure could also be very much inaccurate, as it's calculated using my limited abilities in creating a spreadsheet, and it's very likely that my mathematical ability is wrong. I may have been okay at maths at school, but it's been at least 5 years since I've studied maths, and I can't remember any of it. However, in the year of 2020 to 2021, I got a simple return of 21.09% simple return. Or with dividends added, I got 21.78%, which, if compared to the markets that I'm benchmarking against, the FTSE 100, FTSE 250, S&P 500, NASDAQ, or even the AIM 100, I'm underperforming all of them. But this is also wrong. I don't have the time or ability to create complex mathematical formula to calculate the weighted return compared to all of these markets. And so these markets, or the benchmarks, are calculated using simple returns, assuming that I invested my entire portfolio on the first day of investing, which is very unrealistic as it's a calculation between lump sum investing of money that I would never have had at that point in time versus pound cost averaging, which I've consistently done over the last year. This assumes that I invested my entire portfolio on day one, which is, simply put, very biased. I'm going to assume that I've very much underperformed the markets, and I'm going to take my simple return versus that lump sum return of the benchmarks, and I'm going to try and beat it, which means it would be even more of an impressive feat if I'm able to do so. And it means if I've got the view that I'm always underperforming, I may be outperforming the likes of the FTSE 100, but I want to do better than them all. So if I keep at it from a standpoint of myself underperforming, then perhaps I might have a better mentality or mindset, and it may help me reach that target much easier. However, everything that I've just said up until this point is a lie. Well, it could be. This is because I make money through referring users to Freetrade that then sign up and get a free share. In return, I also get a free share too. Speaking of, if you'd like a free share worth up to £200, click the link in the description down below and sign up to Freetrade. These free shares that I get from Freetrade are added to my Freetrade account. Therefore, I would have to deduct the entire amount that I've made through these free share referrals and then take that from my entire gains in my portfolio. In total, I made £348.99 from referring users to Freetrade in the last year, primarily because I only started referring users around halfway through that year. So if we minus £348.99 from 4,477.83, we get a completely pointless answer. It doesn't make up much of that entire number, but also free shares, believe it or not, are added to a general investment account and not an investment ISA in which my portfolio is entirely invested in. And so one of the arguments presented in that video in which investing portfolios are full of lies is the idea that free shares can be used in propping up the performance. This is very much the case in people that aren't using investment ISAs, as for some bizarre reason they do count it as performance using Freetrade's own performance tracking. However, in my regard, since I am invested inside an ISA, this is not the case. Although you as the viewer would have to trust me as a random person on the internet that's creating content on YouTube. And you have to trust me to be honest and that I'm not inflating my performance to make myself sound better than I actually am. At which point one would naturally be suspicious. And rightly so. And a valid point made in this specific video was that the use of screenshots could be easily manipulated, like using Photoshop, to therefore inflate someone's returns and make them look better than they seem. I agree this could be a very effective way of deceiving viewers. I will also argue that the same thing could be done with videos, and it's just as easy to edit video footage to make it seem like it's better than it is. So an individual could take the time to edit either the screenshots or the videos and make it seem better than they actually are if they're after some recognition, for instance, online. So I couldn't really prove myself, as I use screenshots personally as it's easier. Much easier when video editing, and I can show exactly what I need to without trying to sync up a video of me scrolling with the edited footage itself. And so I couldn't prove myself right or wrong by using videos or screenshots. Also, if I was going to fake my returns, wouldn't I make them look better than they actually are so that I could get perhaps more respect or recognition on YouTube? Ultimately, this isn't something that I could prove legitimately or not. Well, except in the bottom of the description down below, my entire Simply Wall Street CSV file, which had shown my performance that I had shown you in this video, will be down there. So you can do your own due diligence yourself and decide whether it's legit. Obviously, I could have edited this, but if I've had the time to edit over that many different transactions for the sake of making myself look better with the chance of so many inconsistencies to occur, I hope that you can at least get your own view on this and you can decide for yourself whether I'm lying or not. Please note that Simply Wall Street does not track stamp duty fees or deposits. I feel that this is still very early in my investment journey. I feel that I've made a lot of mistakes over the last year and that I'm likely to continue making these or more mistakes as the future comes. But I hope that during this time period that I've learned as many valuable lessons as possible, whilst the mistakes made now may be much less critical to a portfolio of a substantially larger size. I don't feel that 1 year's worth of performance is an accurate measure to track an individual's potential performance in the future. Instead, it's likely going to be very inaccurate. I'm personally going to aim to get a compound annual growth rate of above 15% each year, which according to my simple returns in the last year, that's 6% less. But 2020 was a very anomalous year to say the least, and it was very high in returns. If I'm able to beat 15% each year, I'm personally satisfied, and over the longer term that will compound my wealth surprisingly fast. If you're interested in my Freetrade UK app review, then click the card at the top right of the video. Thank you for watching. I hope you have a fantastic day.